Welcome back to Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today's topic comes from Sarah M., who says, I've been listening to your podcast for a few years and enjoy the increased weekly frequency. My employer started a 401k with traditional and Roth options this year. Since I'm over 50, can I contribute $30,500 to my Roth at work and $8,000 to my Roth IRA for a total of $38,500 for 2024? Would my contribution limit change if my employer also contributes to my 401k above the $30,500 that I put in? Those are excellent questions, Sarah. Thank you so much. And I really appreciate you being a longtime listener. I love that you want to put as much as possible in Roth accounts. It's a great idea. I'm going to explain what a Roth is, how many Roth accounts you can have, and the maximum amounts you and your employer can contribute to them annually. Welcome back, everyone. Thanks for joining me. If you're new here, I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. If you're interested in being your own boss, or maybe you want to take your small business to the next level, I want to invite you to check out my latest book, Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. It's available as a paperback, ebook, or audiobook wherever books are sold. To learn more about my other books, my debt and credit online money courses, or how to work with me, visit my website, lauradadams.com. All right, let's talk first about the difference between traditional and Roth accounts in case there's anyone out there who's not clear about the differences. So traditional accounts like a traditional 401k or a traditional IRA allow you to make tax-deductible contributions. So that means you're making them on a pre-tax basis, and those contributions reduce your taxable income for the year, and that typically lowers your taxes. However, when you take withdrawals of your traditional contributions and earnings, they are taxed. They get taxed as ordinary income in the future. Plus, you may also pay a 10% early withdrawal penalty if you tap a traditional retirement account before age 59 and a half, unless you qualify for a penalty exemption. Now, Roth accounts, such as a Roth 401k, a Roth 403b, a Roth IRA, they're very different. They're the exact opposite when it comes to taxes because they require you to contribute on an after-tax basis. So that means you're not getting any tax benefit in the current year. Your original Roth contributions can always be withdrawn at any time with no taxes and no penalties because you're putting them in on an after-tax basis. They've already been taxed by the time they get in the account. However, if you're younger than 59 and a half, taking out any earnings from a Roth would be subject to income taxes and a 10% penalty unless you qualify for a penalty exemption. But once you've owned a Roth for 5 years and you're over 59 and a half, you can withdraw your account earnings entirely tax-free. And as I mentioned, you can always get your contributions out tax-free. So Roth accounts do give you a lot of flexibility. And all the benefits of a Roth account are a really big deal because you could have decades of growth in the account that never get taxed. So that's really different from a traditional account where taxes on your investment growth simply get deferred. They kind of just get delayed until a future date. So how do you know if you should have a traditional or a Roth account in the first place? Well, whether you should choose traditional or Roth depends on whether you prefer a tax deduction on contributions in the current year. Using a Roth can make a lot of sense if you believe your income or maybe your tax rate will be higher in the future than it is now. In other words, paying Roth taxes on those upfront contributions at a lower rate is better than paying taxes later on at a potentially higher rate. And even if your income in retirement won't be higher than it is now, you might strongly believe that tax rates for all Americans will rise in the future. Or maybe you just don't want the hassle of paying income taxes to the federal and state government, depending on where you live, on your future retirement income. So all those situations or beliefs are really good reasons to favor loading up one or more Roth accounts. But if you believe your future retirement income and your tax rate will be lower than it is now, deferring taxes with traditional contributions may be best. And if you're unsure, I always recommend you can split contributions 50-50 between traditional and Roth accounts. Whenever we're talking about Roth accounts, we need to review who qualifies for them. Now, unlike a traditional IRA, you can only contribute to a Roth IRA when you earn less than an annual threshold. And that threshold depends on your tax filing status, so whether you're single or married, and whether you're filing taxes jointly when you're married or separately when you're married. And it depends on your modified gross income, or MAGI, or MAGI, however you want to say that abbreviation. So let's review the 2024 income limits to qualify for a Roth IRA. If you're a single taxpayer, you must have a MAGI less than $161,000. And you actually qualify for a reduced Roth IRA contribution when your MAGI is in a range, when it's from $146,000 to $160,000. But you can make a full Roth IRA contribution when your MAGI is under $146,000. And again, if it's over $161,000, that's at the point where you are ineligible for a Roth IRA as a single taxpayer. Married taxpayers filing jointly have to have a MAGI less than $240,000, but you're going to qualify for a reduced contribution when your MAGI is from $230,000 up to $239,000, and you can both make full Roth IRA contributions when your MAGI is under $230,000. And again, if it's over $240,000, that's when you are ineligible. And if you're married filing taxes separately, you have to have a MAGI less than $10,000 to qualify, and that's for a reduced contribution. So, basically there's not much benefit when it comes to the Roth IRA if you're married but filing separately. However, you can use the single limits that I just reviewed if you're a newlywed and you haven't lived together in the past year. But the following year, you're kind of want to look at filing jointly to see how that's going to affect your taxes versus filing separately. If you have a Roth IRA, but you become ineligible in the future, so if your income increases, you can keep your account indefinitely and just enjoy its tax-free growth, but you can only make new contributions to a Roth IRA in the years when your income is below the annual allowable limit. Note that there are no income limits for a workplace Roth. So that might be a Roth 401k, a Roth 403b. So if Sarah is within the Roth IRA income limit for her tax filing status, she can max out a Roth IRA. And as she mentioned, the 2024 contribution limit for a traditional or a Roth IRA is $7,000 or $8,000 if you're over age 50. So how many Roth accounts can you have? Well, if you qualify for a Roth IRA, you can also max out a traditional or a Roth workplace retirement plan in the same year. If you're under 50, your maximum contributions would be $23,000 to your workplace Roth and $7,000 to your Roth IRA for a total of $30,000. And if you're like Sarah and you're over age 50, your maximum contribution would be, as she mentioned, $30,500 to a Roth at work, plus $8,000 to a Roth IRA for a total of $38,500. Now, if you earn too much for Roth IRA contributions, you can contribute to a traditional IRA instead when you also max out a workplace retirement plan. However, depending on your or your spouse's income, Traditional IRA contributions may not be deductible when you or a spouse also participate in a retirement plan at work. So that won't prevent you from contributing to a traditional IRA, but it may not allow you to get those pre-tax deductions. So what's the contribution limit on workplace retirement plans? So in addition to the high contribution limits that I reviewed, workplace retirement plans typically have another terrific advantage, and that is matching funds. Often employers incentivize workers to participate in their retirement plans by saying, hey, we're going to match your contributions that you put in up to a certain limit. For instance, your company might match 50% of your contributions up to 6% of your salary, or they might match 100% of your contributions up to 3% of your salary. They can really determine whatever match they want. But the bottom line is that the matching contributions are free money that you should always take advantage of. So you always want to make sure that you're contributing at least enough to get the full match from your employer if you have that offering at work. Note that matching funds typically get deposited into a traditional account on your behalf. So even if you contribute to an after-tax Roth 401k or 403b, any matching funds from your employer typically go into a pre-tax account. And that's so you don't have to pay tax on their matching contributions. And another excellent benefit of workplace retirement plans is that employer matching does not count against your annual contribution limit. For 2024, the total contributions from you and your employer can be up to 100% of your salary, or $69,000 if you're under 50, or up to $76,500 if you're over 50. For example, if Sarah earns $100,000, she could contribute up to $30,500, and her employer could contribute up to $46,000 for a total contribution of $76,500. And if you're under 50, you could max out a workplace plan by contributing $23,000, and your employer could add up to an additional $46,000 for a total of $69,000. That would be a pretty generous match. But the additional funds from an employer could be in the form of matching, which would be based on your contributions, or they can come from profit sharing. So that's based on company performance. So that's how most people would get to those really high contribution limits. It would come through some type of a profit sharing. So the high contribution limits and the lack of income limits make a Roth workplace retirement plan an excellent option to invest for retirement. First, I would prioritizing maximizing your Roth at work. And if you do that, then consider contributing to a Roth IRA if you qualify. Sarah, I want to thank you again for this great question. I hope this has been helpful. I hope you can max out both your Roth at work and a Roth IRA. That would give you such a great boost to your retirement savings. This is episode 842, which means there is a ton more Money Girl for you to explore in previous episodes. So make sure you're aware of all the episodes in the archive. Also, follow me on Instagram and also follow the Money Girl Facebook page. If you have a question you'd like me to cover, please leave it on our voicemail line at 302-364-0308. You can also send me an email using my contact page at lauradadams.com. And while you're there, don't forget to sign up for the free Money Stack newsletter. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. It's audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.